Unmute your mic. Go ahead.
Today we'll be discussing financial planning. I'm not seeing my slide, so I can move it. Once again, you are welcome. Today is the third day of the training, and we'll be discussing financial planning and bookkeeping, as I said before. My name is Popai Christopher. A seasoned business incubator with over 10 years experience in inventory management, bookkeeping, accounting, auditing, data protection, and an educationist. I hold HND in accounting, postgraduate diploma in education, and a certificate program in data protection. So we'll be discussing financial planning and bookkeeping, the objective of financial planning and bookkeeping. At the end of this session, participants should be able to understand financial planning activities, differentiate long-term from short-term plans, understand reasons for bookkeeping, identify bookkeeping method, record financial transaction, balance the account. You can't run a healthy, successful business without having your books in order. Account, financial planning and bookkeeping, which involves accounting, is very important in every business. And that's why it was made to be part of this training. And as you know that you cannot run a business without having a proper accounting books. There are so many books of accounts we are supposed to keep, which we'll be discussing today, one after the other. What is financial planning? In a note, planning is the predetermined course of action. Then what is financial planning? Is the plan needed for estimating the fund requirement of a business and determining the sources for the same. It's essentially include generating a financial blueprint for companies' future activities. Objective of financial planning. There are so many objectives, reasons why you should make a plan in your business. To ensure availability of funds, to estimate the time and sources of funds, where to get this fund for your business and how to spend the fund. Generating capital structure. What is capital structure? It's a combination of debt and equity. Where are you getting this money? Is it through personal savings, borrow from banks, avoiding unnecessary funds? What do you mean by unnecessary funds? Unnecessary funds is a situation, maybe you need money, but where you are going to get this money, the interest rate is high. You have to consider it is necessary going in to borrow this money from this financial institution or not. Are we together? Can we continue? What is fixed asset? Fixed asset is resources controlled by an organization. All the properties, equipment, and machineries of an organization, that is what is called fixed asset. Research and development activities. For you to engage in your business, you make research and develop other things that you need to fix your business up. You go for market survey to know the demand for those items you are doing on. Capital structure, as I say, capital structure are the place how you get your funds, how you source your funds, maybe through debt and personal savings, equity, sources of financing. Where do you get those funds from? Is it from bank and other financial institutions, or your savings? These plans are generally supported by a series of annual budget and profit plans. We talk about the short-term operating financial plans. And short-term is all about the tactics to achieve a specific goal of an organization. You just like a mission statement. achieve the overall goals. Action plan specify short action. Okay. Sorry, we're having network problem over here, but by His grace, it will not happen again. Cash budget is a statement of frame. My skin is. Can I move this thing up? Let's plan inflow and outflow of cash. When we are talking about internet connection is unstable. When we are talking about inflow and outflow, we are talking about the revenue and expenditure of an organization. So cash budget is a statement of the firm's plan inflow and outflow. The inflow is the revenue, while the outflow is the expenses. What is an expenses? The decrease of economic benefit as a result of act. And so about money going out, expenditure, and inflow is the increase of economic benefit as an inflow to an organization. It is used to estimate short-term cash requirement with particular attention to anticipated cash surpluses and shortfall. Budgeting cycle. We talk about performance planning in budgeting cycle. What is performance planning all about? How to go about your goals, your objectives in your organization with alternative, providing a frame of reference, investigating variations if there is variations. For example, maybe in 2019, you find out that 2018 was better than 2019. You try to find out what actually happened. A typical example is 2020, for example. You know, COVID-19 has affected so many things. What you expected to achieve in this year, 2020, maybe end up not getting up to the half of what you had in mind of achieving in this year. So many businesses were affected because of COVID-19. Correction of actions. You try to make amendments and find out what actually happened. Then you go back to plan again on how to further the activity. Strategy, planning, and budget. As I said, that strategy is how to achieve the overall goal of an organization, the overall goal, the vision statement of an organization, that vision statement, where you are going to, how you get to the permanent side of your business, that's strategy. Planning, as I said, is a predetermined course of action, and budget is already budget. You talk about the framework of action. budget, it is an authorized financial of an organization. I said that when we are talking about long-term planning, we are talking about strategy. When we talk about long-term planning involves the mission statement. We talk about the short-term planning, we are talking about how to achieve the titles, which is the mission statement. That is to achieve a specific action. Are we together? Circle of money. Circle of money is all about money movement from the borrower, from the lenders to the borrowers. The primary function of finance is the movement of money from lenders to borrowers and back again. So for example, as you are trying to access this money for NISA, you know the steps involved. The first step is training, which you're already doing now. That's the first step. After which, application in for this. After the application, maybe the loan is granted, you receive the money. The next thing, you put it into business. After to anything and finally pay back this money. That's an example of someone. This is referred to as a circle of money. After this training, you apply for the loan, get it, go into business, get income, and pay back the money. And all this are what you are supposed to know at the back of this money. Am I communicating? I hope we are together. Now we go to, if you have any questions.
Use this system. Yeah, which system?
Time, it's network. Okay, no, this one. Okay. Now we go into the second section of this module, which is bookkeeping. What is bookkeeping? Bookkeeping is the first phase in accounting. It's all about recording of transactions, revenue and expenditure. We'll discuss revenue and expenditure in this very session very well. Bookkeeping involves the recording on a daily basis of a company financial transactions. With proper bookkeeping, companies are able to track all information on its books to make key operating, investing, and financial decisions. Bookkeeping is all about recording inflow and outflow of an organization. It's all about recording the transactions, income and expenditure, revenue and expenditure. With proper bookkeeping, companies are able to track all information on its books to make key operating, investment, and financial decisions. Bookkeepers are individuals who manage all financial data for companies. You are one. I will say that you are a bookkeeper because you have been in business as an entrepreneur. You have been keeping some record, but the difference is that some of you have been keeping incomplete record. Maybe you recognize revenue and you didn't recognize expenses. That is incomplete record. And I know so many of you are victims of incomplete record. Without bookkeepers, companies will not be aware of their current financial position. Importance of bookkeeping. Bookkeeping will help you to measure the company performance, provide information for strategic decision. And I've told you that strategic decision are vision statement of an organization, how to achieve the overall goal of an organization. That's strategic decision. Provide benchmark for revenue and income goals. Fulfillment of legal and tax obligations. Provide stewardship to investors. What is stewardship? Accounting for what is entrusted unto your hand. Giving a proper record of what was given to you, accounting for it properly. That is stewardship accounting. Proper management of cash flows. Now go to accounting basis. Accounting basis, there are two basics of accounting. One is cash basis. Cash basis is all about you recognize cash when cash is given. Record transaction only when cash is actually received or paid. The meaning of this is that no credit. You only say on cash basis. No credit. That's the simple meaning of cash basis. No credit. We talk about the accrual basis. Recording transaction when it occurs, even if cash is not received or paid. Accrual basis is the common basis in accounting. It's the accepted basis in accounting. Because you make provision for debtors. You make provision for creditors. Who are debtors and who are creditors? The debtors are people that buy your product on credit without paying immediately. You make provision for them. You have debtors book, account receivable, and creditors book, account payable. People you buy goods from without paying them immediately. For example, you purchase 100 units of a product and will pay for it next month. In cash basis, no transaction is recorded because it's a credit purchase. No transaction recorded. In accrual basis, transaction recorded through an account payable, which creditors account. Are we together? Can we continue? Now talk about the method of bookkeeping. We have single entry bookkeeping. And single entry bookkeeping is a straightforward method where one entry is made for each transaction in the books. It's not talking about debit. We'll soon discuss debit and credit. It's about debiting without crediting. It's a straightforward method where one entry is made maybe debit entering or credit entering. We talk about the double entry bookkeeping. Double entry bookkeeping is more robust. It follows the principle that every transaction are fed at least two accounts, and they are recorded as debit and credit. In this case, there is a provision for to record the debit entering, and all revenue are credit entering. All expenses are debit. Am I communicating? For example, if you sell a bag of cowpea for 20,000, the entries debit cash and credit sales. You debit the cash account that you have received this money, and you credit the sales account that this goods has actually gone out. We talk about the accounting systems. Accounting system is designed to correct, document, and report on financial transactions affecting businesses. So many businesses have poor accounting system, and that's why this very module was made for you to understand that you have to strengthen your accounting system to enable you carry your business effectively. If you have poor accounting system, you cannot run your business very well. You'll be having issues. I don't know how my money is moving. I know I made sales of 10 million naira yesterday, but I don't know how I spent it. But if you have a proper accounting system, you document it. No one naira will move out of your organization without being recorded in the book of accounts. So it is designed to correct, document, and report on financial transactions affecting businesses. We have manual accounting system. Most of us, or most of you keep manual accounting system, hard copies, processed by hand. And the next is computerized accounting system. Financial information is recorded by entering it into a computer. That's computerized accounting system. Bookkeeping with and without a computer program. Why do you need to know that since there are so many computer programs out there you can use? Have you ever heard the saying, garbage in, garbage out? For you to make use of your computer very well, you have to key in correct information. Because what you give to computer, that's what computer will process and give back to you. That's garbage in, garbage out. If you key in wrong information, you generate wrong report. So in computerized accounting system, you have to be careful on what you are keying in, what you are typing in your system to avoid wrong reports. You have to understand the basic bookkeeping behind what you enter into the computer program in order to enter the correct information. We are now going to discuss accounting proper now. Accounting. We have been discussing financial planning, bookkeeping, and now we're talking about accounting system. What is accounting? Accounting is the art of recording, summarizing of financial statement to the users in such a way they will understand the financial report. Am I communicating? So accounting is the art of recording, classifying, summarizing, analyzing financial transactions of an organization. In accounting, we have what is called GAAP. And GAAP is the generally accepted accounting principle. This is a principle that all the accountants they use in preparing financial reports. All accountants use the same set of rules to prepare financial report. The Financial Reporting Council issued these rules. Financial report is a summarized information about the financial status of a business and the range of business. Because it is so that fundamental to the communication of financial information, accounting is often called the language of business. Accounting is called the language of business. Financial accounting focuses on reporting information to external users. The financial report is being used by external users and the internal users. Who are the external users? The government, the public. We talk about the management accounting. When we are talking about management, we are talking about the managerial accounting. It focuses on reporting information to management, often referred to as accounting for internal users of accounting information. The report you give to the top management of an organization is called management accounting. You report to the MD. For example, as an auditor, you went for auditing. After everything, you prepare a financial accounting report and management accounting report. The management accounting report will go to the management, telling them your observations. You state your observations and your suggestions, what you think they can do to help them to carry on the business effectively. That's management accounting. Who are the users of accounting report? Who are the users? I say that the external users are government, general public, civil societies, and vendors. Individuals outside the business who have an interest in the business are external users of financial report. The government, all these individuals, they have interest. Why? They are interested in the financial report. The government is only interested because of tax purposes. They want to know and ascertain the amount they will charge you for your tax. That's why they are interested. The general public want to know whether your business worth patronizing, to know how they can patronize you. Whether it's a going concern, it's not tomorrow. You tell them that this business is no more in existence. Just like the civil society as well. The lenders, the bank. National Microfinance Bank may ask you to bring your financial report. Why are they asking you to bring your financial report? They want to know whether you are making profit in your businesses, whether you will be able to pay back this money if this money is being given to you. That's why they are interested in your financial report. And these are the users, the external users of financial report. We talk about the insiders, individuals inside the business. Who are the individuals? The shareholders, the owners of the business, the managers, the employees. The shareholder is interested whether the business is making profit. All he wants to ensure that the business is making profit. The manager, the same thing. The employees, the manager is part of the employees. They are interested because they want to ask for increment in their take home. Their salaries, they want to ask for increment. That's why they are interested. If the business is doing well, to pay for increment. Am I communicating? Primary accounting report. The information result of an accounting system. The balance sheet. What you have and owe is the balance sheet. Asset minus liability is equals equity, and liability plus equity will give you asset. Income statement, how much you make. Your income statement is all about inflow, sales. Income statement are your sales, your revenue, what you earn. And cash flow statement. Cash flow statement is all about the cash movement in and out of an organization. What is the liquidity position of the company? Cash inflow minus cash outflow, give you cash and cash equivalent. Are we together? Are we together? This will take us to balance sheet. The balance sheet. And I told you, balance sheet is made up of 3 components, 3 elements of accounting. The balance sheet will tell you about 3 elements of accounting. The balance sheet will tell you about liability, equity, and asset. What is an asset? An asset is the resources controlled by an organization. That's what is called asset. You have fixed asset and you have current asset. Fixed asset is called non-current asset as well. And I said asset is a resources controlled by an organization. All the non-current assets, as I said before, the non-current assets are your equipment, machineries. Just as you are applying for this one, you are asked to bring the equipment. What are the equipment that will help you to carry out this business? These are called non-current assets. It's an asset, but non-current. Why is it non-current? Because you depreciate them. And current assets are the cash, this working capital is the current asset. I'm very much aware that you have filled your form. In that form, you see equipment and working capital. They are talking about the asset of your organization. What you want to use the money to do, to buy the equipment and the working capital. Equipment and working capital put together is called assets. We talk about the liability. Liability are your creditors, people you are owing. There are people you are owing. And liability is a decrease in economic benefit. Your present obligation. You know, once this money is given to you, it becomes an obligation that you pay back this money. And I have told you how this is run. The first, you undergo the training. Second, you apply for it and assess it, take it, do business. The next, you make income. And the final stage is to pay back the money. So a liability is a present obligation because it becomes an obligation that you must pay. Once the money is given to you, you must pay back the money as at when due. Equity. What is an equity? Equity in a nutshell is a residual interest. When I say residual interest, after removing the liability, what you are owing people, what is remaining there becomes the equity. What the shareholders can share among themselves. That is equity. That will take us to income statement. Income statement is made up of 2 elements of accounting, revenue and expenses. And I told you that revenue, you can equally call revenue income. So in this income statement, we'll be discussing revenue and expenses. Am I communicating? Revenue, what is revenue? Revenue is the decrease. Revenue is the increase of economic benefit as an inflow to an organization. What you earn, your sales is your revenue. Sales is revenue. What is expenses? A decrease of economic benefit as an outflow to an organization. Expenses is talking about the cost of sales. What is cost of sales? What you spend to earn the income. That's expenses. It's a decrease in economic benefits as an outflow to an organization. Now, we talk about profit. Profit is revenue minus expenses. What you earn minus what you spend will give you profit. It's either you make profit or you make loss. If what you spend was more than what you earn, you cannot make profit. And no man, no woman in business prays to go into business and not making profit. Your intention in business is to make profit. That's the end, the third line of business, to make profit. So revenue, profit is revenue minus expenses. In that case, their revenue must be higher for you to make profit. Am I communicating? Are we together? Okay. This is a typical example of balance sheet. This is a typical example of balance sheet. You can see assets, current assets, and I told you that current assets are your working capitals. Cash and cash equivalent. Account receivable. What is account receivable? Account receivable are your debtors, people that are owing the company, people that bought goods on credit from the company. They are all called account receivable. We talk about the inventory. What is an inventory? The goods you deal on. Maybe you produce fowl, chicken. These are your inventory. You buy the old chicken. These are your inventories. You are into fishery. You buy fingerings, buy post fingerings. These are your inventories. What you have in stock. Inventory is called stock. Your stock, what you have. Prepaid expenses. What is prepaid expenses? Expenses made ahead of time. For example, your rent, most of you will pay your rent on annual basis. It is a prepaid expenses. You buy airtime. It's a prepaid expense because you have not consumed it. You buy airtime, you pay for it, it's in your phone. Maybe 1 minute call, maybe 10 naira gone out, 19 naira is still there. It's a prepaid, you have incurred these expenses, but you have not consumed it. Am I communicating? Talk about investment. And that takes us to the next asset, property and equipment. Property and equipment. These are non-current assets. This is called non-current asset. Land is a non-current asset. Building and improvement is a non-current asset. Equipment, all these are non-current assets. Other assets, intangible assets. What is intangible asset? We talk about goodwill in business. And what is goodwill? What the reputation your company is known with. For example, if somebody want to acquire your company, and your company actually have been doing very well, you acquire it with goodwill. People have known your product, people have been patronizing you. So you charge him for goodwill. That's what we mean by intangible asset. A goodwill is an example of intangible asset. Now we'll talk about the liability, examples of liability and shareholder equity. You have current liability, and these are account payables. People you are owing that wish to pay them back maybe within 1 year time. These are account payables. No payables, acquire expenses, deferred revenue. And long-term debt. And I've told you what long-term means. A debt that you cannot pay within 1 year. That will take you, like what you are going into now, will be around 10 that will take you maybe 5, will take some of you 5, 7 years to pay back this money. These are around 10 debts. Am I communicating? We talk about the shareholders' equity. Shareholders' equity. I told you that equity is a residual interest. Shareholder equity, and those what the shareholders will share among themselves, like the common stock, you have 3 shareholders, and the share capital of the nation is maybe 1 million naira. They share you among themselves 500, 200, 300. Are we together? Am I communicating?
You are communicating, my brother.
Okay, you're welcome. Retained earnings. What is retained earning? All the profit you have made so far in your business in the past years is called retained earning. It's all your profit, but added together in the past years, maybe you have been in business for 5 years. What the profit you have made so far in those years is called retained earnings. Treasury stock. Are we together? I can hear you. Thank you. We now talk about the income statement. I have given you a typical example of balance sheet. Now, this is a typical example of income statement, and I told you that income statement is made up of 2 elements of accounting, which is income, revenue. Balance sheet, and I told you it's made up of 3 elements of accounting, which the assets, liability, and equity. Now the revenue and expenses, sales, and I told you sales is revenue. This is a typical example of income statement. Your account service revenue, book sales, professional consultation, all these are sales revenue generated by an organization. What revenue means, and I say revenue is an increase in economic benefit as an inflow to an organization. Expenses is a decrease in economic benefit as an outflow to an organization. What are the expenses incur in your businesses? The common expenses is wages. You pay your workers. Assuming maybe you are a sole proprietor, you don't have any employee, you pay yourself. That's the mistake some of us we. Can I be unmuting on mute? Okay. Okay. So that's a mistake. You don't consider your own take home. You're supposed to be paying yourself, assuming that you are the MD. Every month, you set up maybe your own take home is 100,000, 200,000. That's your own take home. But you don't take all these things into consideration, or you know that I make profit. But if you check all this, maybe you're paying yourself 200,000 every month. By 12, that's 1.2. That's 1.2 million naira. And you saw profit of 800,000, you'll be shouting, I made profit. How do you know that you made profit if I did not pay yourself? So wages is the common expenses in a business. If you don't have any employee, even the one you take as the owner of the business is enough to reduce the income, to reduce the sales. Marketing and advertising, for people to know about your product. You may decide to take it, go to radio house, television, for them to know about your. You spend money on advert, which is very important. You share handbills, you print banners, all these are called marketing and advertising. Rent, that's another expenses. It's a common expense all of us will incur in the course of business. You pay your rent. Come on, you pay your rent on annual basis. Utility bills, your NEPA bill, and others. Membership and publications. Possibly you are a member of one organization or the other. As a professional, you pay your membership and it's an expenses. Insurance, it's an expenses. Consultant. Now we are not doing this on behalf of you. You pay consultancy fee. It's an expenses. It's part of your expenses, which you have to maintain. You record them in your books of account. Pay maybe 20,000 naira. Talk about the office supplies. You must take all this into consideration. For most business owners, they keep incomplete record. They only recognize income once money is coming in. But when they are spending, they are not taking record of what they are spending. That's what this very module was made for you to understand, but that you have to keep proper book of account. And this will help you to know how you use the money, to know at any point in time how this money was spent and what you generated. If anything is going wrong, it will help you to know in time that something is going wrong. I don't have much money with me again. You will know how you spend the money. Are we together? Can I continue? Okay. So after all this, that's when you can ascertain your profit. You have non-operating gains, interest income. Most times you see bank crediting your account with 1 naira, 10 naira as interest. These are interest incomes. Loss on sales of assets. Maybe your asset has depreciated that you cannot use it again. Donations, gifts. All these are non-operating gains. They are profit you made in your business, but not operating. Donation, somebody donated something to your organization. It's a gift. The final position for income tax, you pay your tax. You pay your income tax, company income tax, personal income tax. As on the MD of an organization, you pay personal income tax. You pay payee, pay as you earn on behalf of your employees. Am I communicating? Can we continue? Very soon we'll be coming to an end of this very module. And I know so far so good that we have been able to understand what income statement is, what balance sheet is all about, what bookkeeping is all about. And all these things are talking about accounting system to maintain a proper book of an account. I think it's 1 minute. Are you with me? Components of accounts. Component of account. I have almost discussed everything about this component element of accounting. I said we have 5 elements of accounting. What are these elements? Assets, liability, equity, revenue, and expenses. The basic unit of accounting is an account or general ledger account. It is a unit of information that represents business report. There are 5 types of account: asset, liability, equity, revenue, and expenses. And I told you that an asset is a resources controlled by an organization, and liability is the decrease in economic benefit. It's a present obligation. Money you are owing people. This is what you earn. Liability is in a nutshell, is a present obligation, because once you access this loan, you are now liable to pay this money. It's a present obligation. It's a must. When we are talking about obligation, we are talking compulsory. You must pay back this money, and you should have it at the back of your mind. And that's why you have to maintain your books of account so that you know how your transaction, how your money is moving. And we talk about equity. I say equity is the residual interest, shareholders' fund. That's equity. Revenue. I say revenue is an increase in economic benefit as an inflow to an organization. Increase when you earn money, when you make sales, you earn money. It's a revenue. It's an increase in economic benefit to your organization. Expenses, I say it's a decrease in economic benefit as an outflow to our organization. And I have mentioned examples of revenue. Revenue are your sales. Expenses, I gave you examples of expenses, your wages, utility bill, rent, and the rest of them. A business can have anywhere from a dozen to several thousands accounts, with each one being one of the 5 types above. Are we together? Accounting. I have defined what accounting is. And I told you accounting is the art of recording, summarizing, analyzing, classifying of financial transaction of an organization to the users of the financial statement. And I have told you, I have mentioned the external and the internal users of a financial report. I said government is a good example of external users. The general public is an example of external users of financial report. We talk about the internal users, the shareholder, employees. And I said all these users, they have the reason why they are interested in your financial report. So accounting is a process of recording business activities that make changes to account. This includes sales of products, revenue from service aim, buying product or services, incurring other expenses, depreciation of fixed assets, closing books for the year. When any of these and other businesses activities are recorded, accounts change in value. Are we together? Double entering accounting. There is one basic principle in accounting. A basic principle in accounting. The principle says that every debit entry must have a corresponding credit entry. Every debit entry must have a corresponding debit. Every debit entry must have a corresponding credit entry. What do I mean by this? It's about debit and credit. You spend money. You make sales, earn money. When you make sales, you earn money. That means you credit your sales. You credit your sales account. At that point, you have credit debit your cash account. That's what double entry principle is trying to tell you. Maybe you did some computers. You sell computer, you receive money. What the most you have to maintain at that point is your sales book and your income, your cash book. You credit your sales book with that amount, and you debit your cash book with the same amount. For any business transaction, there is a give and take of equal naira amount. That is debit and credit. This is called double entry accounting. There are two types of actions done to account to bring the value up or down. The actions are called debit and credit. Whether an account grows or shrinks when it is debited or credited depends on the account. For example, for an asset account to grow, you debit the asset account. Just as I said, you debit your cash book. Cash book is an asset account. For it to add, you add more value to it. A debit to an asset account makes it bigger, but a debit to a liability account makes it smaller. That's what I'm just trying to tell you. The opposite applies when crediting. Crediting an asset makes it smaller. It will reduce because you are not trying to remove from the money you have in. That's expensive and money going out of the organization. Can I continue? A debit to revenue account makes it smaller. It will go. You have credited that you earn 1 million naira, and you are debiting that you paid for fuel, for wages 800,000. It will reduce it to 200,000 naira. A debit to revenue account makes it smaller, and debit to an expenses account makes it bigger. A credit to a revenue account makes it bigger, and credit to expenses account makes it smaller. For equity, it gets bigger when it is credited and smaller when it is debited. Are we together? A record entry that has debit and credit is called a journal entry. Now talk about the debit and credit of balance sheet. To make an account go up, get bigger, in your balance sheet, you debit the asset account. For you to make from your asset to go higher, you debit the asset account and credit the liability account. Am I communicating? When you debit, you are adding more value to the asset. But when you credit your liability account, that means you are owing people more. Can we continue? Talk about the income statement in terms of to make an account go up, get bigger. In your income statement, when you credit your sales, that means you have sold more of your product. It will make your account go bigger. You have sold more. You sold 10 computers, for example, and you sold another additional 5. Your revenue account will be increasing. Are we together? To make expenses account go bigger, that means you have spent more. You debit your expenses account, you pay for your wages, maybe you pay for rent the same day. You are increasing the expenses account, and it will get bigger. Are we together? Hope I'm communicating. Okay. Debit and credit. When you want your account to go down, get smaller, in your balance sheet, if you credit your balance sheet will reduce. The asset, if you credit your asset, it will reduce. Debit your liability, you don't have paid your creditors. You have paid some people that you are owing. That's when you are debiting liabilities to reduce what you are owing people. We talk about when income statement. For example, when you debit sales, that means maybe there is a return inwards. Somebody bought goods from you and return it. You have to debit it to reduce the value of what you have earned before. That's when you are, at this point, your revenue will reduce, your revenue will drop. You sold something and the person returned it, say, okay, maybe I don't want this thing again. Your revenue will reduce once you accept it back, because you will refund the person that money, the amount you paid before. Your revenue will drop. Then when you credit your expenses, that means the actual expenses that you did not incur. When you credit your expenses, it will still drop your expenses. It will reduce your expenses. As your revenue is reducing, the expenses is reducing. Are we together? Are we together? At this point, we come to an end of this module, and I can say, to my understanding, we come to the end of this module, and so to my understanding that you are able to understand what bookkeeping is all about. Financial planning, you are long-term and short-term financial planning. And I told you your short-term financial planning is all about, your short-term financial planning is all about the mission statement. The title is to achieve the goal of an organization, and the long-term financial planning is all about the vision statement, how to achieve the overall goal of an organization. Are we together? And I have explained what bookkeeping is. I said bookkeeping is the first phase in accounting. It's the recording phase. Recording phase. It's all about in accounting. That's the recording phase. It's the act of record. Accounting is the act of recording, summarizing, transferring of financial statement to the users in such a way they will understand it. That's when we are talking about accounting. Recording, bookkeeping is all about recording. The users may not understand, but when you talk about accounting and the users will get to understand what you do it in such a way the users will understand everything about the accounting. Am I communicating? And I have stated the 5 elements of accounting: asset, liability, equity, income, and expenses. And I'm able to explain to you what asset is. Asset is the resources controlled by an organization. Liability is the present obligation. Equity is residual interest. Income or revenue is the increase in economic benefit as an inflow to an organization. Expenses is the decrease in economic benefit as an outflow to an organization. With this, I will come to the end of this module. If you have any question, you ask. You are,
just tell them to
if tell her to do. Unmute themselves. Okay. Identify. If you have any question, identify by raising up your hand. I can see you. Mr. Cyrus, I can see you. Simeon, I can see you. Are we together? If you have any question, you ask. I'm waiting for any question on what you have done so far. Okay. Mr. Cyrus.
Xperia, you should see his name.
Okay, just ask your question.
Xperia, you see, Xperia. You can't see him. You should tell us this guy.
Rosa, can you hear me? Espera. I don't even know his name. Hello, can you hear me?
Yes.
What's your name, sir?
It's Matthew. Matthew.
Mr. Matthew, you are welcome. You can ask your, go ahead and ask your question.
Yes, you say I need a bit of explanation here about debt to revenue account makes it smaller, and debt to expenses account makes it bigger. Just it's interesting concept.
Okay.
Could you just expatiate on it a little? Yes.
I can hear you. You say revenue account makes it smaller, and expenses account makes it bigger.
Yes.
Okay. I said that will take me back to. I want to share my listen to. Okay, no, I
So,
wanted to show you. It's okay.
to add
That will
on
take
your-
me back to what I have said before. For revenue account to get smaller, I said, for example, somebody bought goods from you and the person paid you. And after some time, maybe the same day or after that day, he came back to you and said, sir, I don't want this thing again.
Yes.
Can you accept it and give me back my money? By that
Good.
time, your revenue is dropping when you are paying back this money.
Correct.
That's one way your revenue gets smaller. You paid for
Okay.
it before, now he returned the goods back to you for you to refund him or her the money.
The money.
Yes, the revenue has dropped at that point. Am I communicating?
You are, sir. Yes.
That's what I mean, revenue getting smaller. Then he said,
That's fine.
expenses getting smaller. You make sure expenses getting smaller. Yes, the expenses can reduce. Take for example, are you hearing me?
Yes, I do.
Take for example, for your expenses to drop, maybe you paid for your rent 1 million naira to stay in that rent for 1 year. Maybe in 6 months' time, you decided to quit the apartment and you approach the owner of the property that you
Yes.
pay for that. You have paid for this money, you have recorded it that you have spent this money for rent. You approach the owner of the property and the person decided to refund you back 6 months. Have you seen now that your expenses now will drop?
Definitely.
So that's what I mean by expenses get smaller, revenue gets smaller or thereabout. If you have any other question, you can ask.
No, that's fine. Thank you. Thank you, sir.
You're welcome, Mr. Matthew.
Thank you.
You're welcome, Mr. Matthew. Welcome, welcome. If there is any other question, I can see Mr. Simeon, Cyrus, Nneka, and Ajun, thereabout.
Okay, I have a question, sir.
Okay, what's your name, man?
My name is Simeon Williams.
Okay, Simeon, you're welcome.
Yes, so fortunately, this is my first time of joining the session.
Okay,
So yeah,
you're welcome.
yes. So yes, I just want to ask this: in a situation whereby you have a particular business model that has to do with membership, maybe the way your mode of charging is just based on membership. For instance, let's look at the physical goods now. That let's say like gym now. Let's say you have a gym that people come in for membership, maybe monthly subscription or weekly subscription and all that. Then also a scenario where you also have an online learning system whereby people subscribe. It's based on subscription, maybe weekly or monthly. I don't know if that is also an acceptable business model. Is my question clear, sir? Is my question clear, sir?
I think the presenter at this point in time is offline until when he comes back. I'm also a participant, but maybe when he comes back, he's going to attend back to the question.
Let them know about it. Eh?
I said, I have no issue if they are asking questions.
Alright.
Okay, I can continue. Hello, Mr. Simons. We're trying to put up a question. Can I hear you now?
Yes, okay.
Hello, Mr. Simeon. We're trying to put up a question. Can I hear you now? Are you there, Mr. Simeon? If there is no any other question, okay, Mr. Simeon, we're trying to ask a question. You can go ahead and ask your question. Are you hearing me? If there's no question, I think we'll come to an end of this module. And I said at the end, you will be able to understand bookkeeping, and I've told you what bookkeeping is all about. It's all about recording of your transactions, keeping record. Sometimes when you hear bookkeeping, some people think it's to gather book on the table or on your shelf. It's not. It's to maintain proper book of account. So you have learned to understand what bookkeeping is all about: financial planning, what is strategy, long-term planning, what is short-term planning, titles. That's their mission statement. Understand what the element of accounting, asset, liability, equity, income, and expenses, and the rest of them. So after this class, there will be a post quiz, and I thought that you will be able to answer the questions appropriately and then screenshot and send back to us on the WhatsApp platform. Thank you, and